Welcome back. It's that time of year again, the last quarter of the financial year. We're all thinking about taxes. Let's face it, while ideally financial planning should be a year-round habit, many of us find ourselves scrambling to optimize our taxes in these crucial January to March months. You're definitely not alone in this. It's a common feeling, and we're here to help. Now, with the rush to save taxes, one avenue stands out for its potential to do more than just reduce your tax burden: equity-linked savings schemes, or ELSS funds. They're not just about saving tax, they're about growing your wealth strategically. In this video, we'll guide you through the essentials of ELSS funds. We'll explore what ELSS funds are and how they work, who should consider investing in them, a step-by-step guide to selecting top-performing ELSS funds, practical tips on how to invest in ELSS, and finally, the key tax implications you need to know. What exactly are ELSS funds? These funds offer a powerful combination: tax savings and equity growth. They're mutual funds designed to let you deduct up to 1.5 lakh rupees from your taxable income under Section 80C of the Income Tax Act. That's a significant chunk of change. And because they're equity-linked, at least 80% of your investment is placed in stocks, giving you potential for higher returns. This could be in large-cap, mid-cap, or small-cap companies, or a mix of all three. This means you're not just saving on taxes, you're also participating in the potential growth of the stock market. However, there's a unique feature: a lock-in period. ELSS funds have a mandatory lock-in of 3 years. This means you can't withdraw your investment for 3 years from the date of each investment. Now, while this might seem like a restriction, it's actually the shortest lock-in period among all tax-saving investment options. Plus, it encourages long-term investing discipline, which is crucial for building wealth. Do you find this helpful? Share the knowledge with family, friends, and colleagues. And don't forget to like and subscribe for more such useful information. Who should actually be considering ELSS funds? If you've opted for the old tax regime and are looking to maximize your Section 80C deductions, ELSS funds are a compelling choice. They offer the potential for higher returns than traditional tax-saving instruments, thanks to their equity exposure. However, if you've chosen the new tax regime, ELSS funds might not be the best fit for tax savings alone. Under the new regime, you can't claim deductions under Section 80C. That said, you can still invest in ELSS for potential capital appreciation, even without the tax benefit. Now, let's understand the core of ELSS. The Securities and Exchange Board of India, or SEBI, defines ELSS as equity-oriented mutual funds. They must invest a minimum of 80% of their total assets in equity and equity-related instruments, as per the Equity-Linked Savings Scheme 2005. That 3-year lock-in? It's not just a restriction. It encourages long-term investing discipline, which is crucial when dealing with equity markets. Most ELSS funds invest flexibly across market caps and sectors, meaning they're usually diversified. They might follow a growth, value, or blended investment style. But here's a critical point: not all ELSS funds are created equal. Some might expose you to high risks without delivering adequate risk-adjusted returns. We're going to talk about past returns because, let's be honest, it's something we all look at, but it's essential to remember that it's not a foolproof indicator of future results. We need to combine it with factors like fund manager experience, fund's investment strategy, expense ratios, your risk tolerance, and investment horizon to get a holistic view of a fund's potential. If you're young, have a high risk tolerance, and are aiming for long-term capital appreciation, then ELSS could be a great fit. Especially if you're looking for returns that outpace inflation. Keep in mind that ELSS investments take time to grow. Don't just focus on the 3-year lock-in. You'll likely need to hold your investment for much longer to see meaningful returns. Expect potential short-term dips along the way. Now, if you're a risk-averse investor, meaning you prefer stability over high-potential returns, ELSS is probably not for you. Instead, consider safer tax-saving options like PPF, NSC, or tax-saving bank FDs. These offer more predictable returns, albeit generally lower ones. In short, ELSS is suitable for investors with a long-term outlook, those with a high tolerance for market volatility, individuals seeking capital appreciation and inflation-beating returns. Now, let's get to the crucial question. How do you actually pick a winning ELSS fund? We will consider ticker tape for screening our ELSS funds. Select Screener and then select Mutual Funds and start screening. From the equity category, we will select Equity-Linked Savings Schemes. This gives us a list of 59 schemes. We will select some filtering parameters. Under Returns, we will select CAGR 3 years, 5 years, 10 years, and 3 years average annual rolling return. From the Risk filter, we will select Maximum Drawdown. This is the maximum observed loss from a peak to a trough of a portfolio before a new peak is attained. From Ratios, we will select Sharpe Ratio. This is a measure of the risk-adjusted performance of the fund, calculated as returns divided by standard deviation of returns. In short, higher the value, better the performance. Next, we will export this list into a spreadsheet and follow a filtering process to shortlist our top 5 ELSS. Here's our data. Let's first filter out funds which have been operational for less than 3 years. This is because we want to focus on funds with proven track record. Next, let's look at 3 years average annual rolling returns. We sort this descending order, keeping the best performers on top. Let's keep the top 15. Though past performance should not be taken as a guarantee of future results, it can offer useful guidance when evaluating a fund's potential. Understanding potential downside risk is crucial for informed investment decisions. That's why we're now going to look at the maximum drawdown, MDD, of these funds. To prioritize risk management, we'll filter our selection based on the funds with the least historical drawdown, focusing on the top 10 performers in this metric. To wrap things up, we're going to take one final look at the 3-year average rolling returns of these funds. We'll then select the top 5 funds with the strongest rolling returns. And there you have it, our top 5 performing equity-linked savings scheme funds. Now, to choose 1 or 2 funds from this list, you can evaluate them further based on fund manager experience. Track record, you can check the 5 years and 10 years CAGR. Expense ratio, a lower value is considered better. Drawdown, a lower value indicates lower volatility. AUM, a larger size can indicate investor confidence. Alright, so you've decided ELSS funds are right for you. Now, how do you actually invest in them? Don't worry, it's simpler than you might think. There are several convenient ways to get started. First up, online mutual fund investment platforms like ET Money, Grow, etc. You can also invest directly through the websites or offices of the asset management companies or AMCs that manage these funds. Many banks and financial institutions offer mutual fund investment services, including ELSS. And finally, you can invest through mutual fund distributors. Lastly, let's talk about the tax implications of your ELSS investments. Remember, after the 3-year lock-in period, when you redeem your ELSS units, any gains you've made will be subject to long-term capital gains tax. They are subject to a 12.5% tax without indexation on long-term capital gains exceeding 1.25 lakh rupees per year. No tax on dividends. The dividends received from ELSS are tax-free in the hands of the investor. In conclusion, investing in ELSS funds is accessible and straightforward. With these options, you can easily start your tax-saving and wealth-building journey. Now go explore your options and be a thoughtful and informed investor. Want to see the top 5 performing mutual funds? Click right here. That's all for today.
Happy investing!